All right, Jitendra Gohil is right here with us. Jitendra, thank you so much for joining us. At Credit Suisse Wealth, how are you really analyzing the market? I was just glancing through your notes. You are more positive on mid caps versus large caps, and indeed, in the last couple of weeks, it is that section of the market very active. Your observations on the broader market, Jitendra?
Hi Ajay, thank you for inviting me on the show and hope you and your families are keeping well. So first of all, as a Credit Suisse house view, we think that for equity as an asset class, we'll see more buying interest because all the asset class they compete for funds. And looking at the debt market, the yields are not very attractive globally as well compared to inflation. So the inflation in US has gone higher, but the bond yields haven't moved much. So that is a perfect sign that we may see valuation may remain elevated. Currently, we are trading at 20 times forward price to earning on Nifty, and we think that this valuation expansion is going to remain till the time yields move up very sharply, which is not our base case scenario. And coming to your question in terms of mid cap versus large cap, what we think is that we are coming out from a very prolonged earnings recession as an economy. We have seen significant deterioration in earnings environment over the past, in fact, 4 to 5 years. And from there, we have restructured our balance sheets. Balance sheets are stronger now. We are also expecting a kind of a broad-based recovery on the economic side. You see the capex, which has started moving up. Private companies are spending. So I think it's going to be a broad-based recovery. And within that, if you look at mid-cap, I think, first of all, the export opportunities, they are doing pretty good. Valuation-wise, they are cheaper compared to large caps. Most of the large cap, generally the valuation discount for mid-caps is around 10 odd %. And we are currently at that level, irrespective. In 2014-15, we have seen significantly higher valuation premium of mid-cap, which has crashed. And now we are seeing a very decent valuation for a mid-cap as a whole. And hence we are looking at a broad-based recovery. We think that the portfolio should be mostly invested in cyclical stocks and also have a good proportion of mid-caps within the portfolio framework. Yes.
Right. Jitendra, what is your model portfolio looking like right now? Have you made recent changes to them? Because as you just said, you are more focused and positive and constructive on the opening of the economy and playing the cyclical because the growth will actually broaden out from here on. So how are you really capturing it in your portfolio construction? If not the stocks, if you could share themes and kind of plays which you have put in there.
First of all, as I mentioned, the banking sector, I think there we have been pretty positive. Top 4 or 5 banks, including the largest public sector banks, we have been extremely positive looking at the valuations and plus the restructuring that they have done. So portfolio context, we have been still buying banks. We think any dip is a good buying opportunity in the large banking space. The second is chemicals. Obviously, we have been discussing this for the past few years now, but I think that sector is doing extremely well. Given the opportunities in the export market, even domestically also, we are seeing these companies are gaining market share. They are actually coming out with a good capital expansion plan. So I think capex plans. So I think expansion is going on. And I think from a 3 to 5 year perspective, this is structurally in the bull market. The third sector, like where we have made recent changes, you can say we have cut down our exposure to metal space. We have been bullish for the past almost like 4 to 6 months. We have been buying steel, we have been buying iron ore, but now we think that the rally has at peak, and we think that while aluminium or copper might do better than iron ore and steel. So we have cut down our exposure to steel and moved to autos. Now, it could be a little contra kind of a call. For the past few weeks, we have been recommending to buy autos. We think that the valuation for autos are now at a reasonable level. We have seen that the commodity prices pressures have impacted the gross margins. And now we think that pressure is going to ease going forward as they have started taking price hikes. So I feel the margin pressure for auto companies will come down over the next couple of quarters. Second, running up to the festive season, we think that supply constraints that these companies were facing is now behind, and slowly and gradually we will see supply constraints to ease. And the third is monsoon. We think that this year, back-to-back, if the monsoon is good this year, we will see back-to-back 3 good monsoons, and we expect record crop production this year as well. And hence the rural demand might be strong if monsoon is better. And lastly, the land prices have moved up, which also will have some of impact on wealth perception in the rural area. So I feel all of the factors are nicely aligned for the auto sector to do well over the next 6 to 9 months. So we have been buying auto, we are selling steel and metal. This is what we have made some changes.
Trimming metals and adding autos clearly seem to be a very differentiated thought. Clearly you are ahead of the curve in metals, and probably that's what you're aiming at in autos, because not many are really talking about it. It's not a popular opinion to buy autos right now given what's happening with them, but ahead of the curve is probably what you're aiming to be. Jitendra, I would like to get your attention on commentary coming in one of the largest private sector banks that things may get the second, third degree impact of COVID second wave could actually hit their asset quality. When HDFC Bank says so, you sit up and take notice of that. I don't want a reaction on the company or the stock, but management view. Also, similar views are coming from lenders association heads, MFI association heads. So this entire worry on asset quality, what are your thoughts there?
So yes, you are right. So asset quality may see some more pressure going ahead, but there are two things that we are looking at. So there are two aspects to asset quality. One is the retail and MFI space that is definitely under pressure. But on the other hand, the corporates, there the stress is significantly lesser than past few years now. Most of the stress tests have been provided for. Resolutions are happening. So I think while the individual loans or microfinance loans may see pressure, MSME loans may see pressure, but on the other hand, the corporates are doing well, which may offset some of the impact. And second, we always buy or always recommend top 5 banks. We are not going below top 5 banks, right? So I think these banks, if you look at past results, they have provided enough to deal with the second wave. Their provision coverage ratios have gone up. They've raised capital last year, so their balance sheet is strong. So in case if asset quality deteriorates more than what market is expecting, I think they are in a better position to deal with that. So that's why we think while you may see some pressure in MFI book or MSME book or individual loans, credit card defaults, I think the provision coverage has gone up very substantially, and that's why they are well prepared. Having said that, we are also looking some of the NBFCs, right? So this could be also a kind of slightly hated sector as of now. But some of the housing finance sector lenders may see good performance going ahead, because we think overall real estate segment is going to pick up. So the lenders towards these developers, although this is a very risky space for this risk and return seeking clients, we are recommending stocks which are lending to the developers. So I feel that there could be a good alpha opportunity available in the second half. When we open up, we think that again we will see a nice rebound in real estate demand. So there also, from a financials perspective, we are positive on.
Jitendra, I would also like your thoughts on the entire global growth play. Cummins were on our channel today saying inquiries for exports are increasing. Similarly, Welspun Indocount also told us the same. Many people are saying that global growth is rebounding ahead of India, and companies which are feeding into it, and of course China plus one is a good pocket or universe of stocks to hunt for good growth going ahead. What are your thoughts there?
Absolutely. So we think in the second half, there could be some good rub-off impact on Indian exports, because look at US, right? So almost 2 trillion plus money is lying with the consumers. Once they open up, the demand is definitely going to surge. and US cannot produce so much so fast, so they will have to import in the second half. So we are closely monitoring what happens to US import. It's a 20 trillion plus economy, and when they start importing, the rub-off impact on export markets will be seen very clearly. So we think that in the second half, our economy also will do well, which is linked to US, except for IT. IT, we are not. We think that the valuation is through standard deviation above its historical average. So IT, although that is exposed to US, we are not extremely bullish. We are neutral on IT, but definitely chemicals, agrochemical space, which are exporting to US, they will see good demand rebound for sure. And remember, in US, market is expecting somewhere close to 6%, 6.5% in that range of GDP growth. But I think, we may see some kind of surprise. If that happens, I think we will see in second half, even Indian exporters will be in focus.
Right. Jitendra, always a pleasure chatting with you. Thanks so much for joining us on the show today.
Thank you for your time. Thank you very much.
That was Jitendra Gohil, Head of Research at Credit Suisse Wealth.